So good evening, everyone, and welcome again to today's class. Is Advanced Financial Management for Advanced Level, CPA. And we're talking about the special topics in financing. And to be specific today, I want us to talk about lease or borrow to buy. Lease or borrow to buy options. The concept of leasing or borrowing to buy, the question that you're being asked is very simple. We need to make a decision between leasing an asset or buying an asset. And in making this decision, we are going to compare the NPV of leasing option with the NPV of buying option. We know that leasing option has the following effects. The leasing option has the following effects. Number one, after tax, lease rentals, after tax lease rentals annually or periodically. Number two, there will be savings. Let me call it annual savings. Annual savings in after tax maintenance costs, if any. And anytime we're talking about after tax, it should be 1 minus T. 1 minus T. Even the after tax up here, whatever we have, we adjust for tax, 1 minus T. Number three, leasing options can also involve the purchase price. The purchase price after expiry of this contract, if any. With the buying option, number one, we have the initial outlay. Initial outlay. Number two, we have annual after tax maintenance costs. Remember, it is 1 minus T. Number three, we have the annual after tax interest on loan borrowed. On loan borrowed to acquire or borrowed to buy the asset. So remember, it's 1 minus T. And in doing this, we may prepare loan amortization schedule. We may prepare loan amortization schedule. So So let's check a question in September. September 2021. Question number 3, boy. Question 3B. September 2021, question 3B. That's about Zeltex Limited. So Zeltex Limited intends to acquire, so the question displayed is September 2021, question 3B, intends to acquire a mainframe computer for processing and storage of its data. The computer is expected to cost 800. So when we buy the computer, it will cost 800,000. The finance director has made 2 proposals for acquiring the computer. The first one, leasing option. Lease the computer for 5 years before the new model is introduced. The lease payments constitute 150,000 per annum for 5 years. Repair and maintenance costs incurred are estimated at 100,000 per annum for 5 years. The firm can choose to exercise the option to buy the computers for 100,000 after 5 years. Purchasing, the firm can borrow 800,000 from a commercial bank at an interest rate of 16% per annum to finance the purchase of the asset. The interest on the loan is payable on a reducing balance. Salvage value of the asset is estimated at 150,000 after 5 years. Depreciation is on reducing balance. Tax is 30%. Service and maintenance costs would amount to 80,000 per annum. An evaluation of both option 1 and option 2. Good. Now, if we can start with option 1, option 1, that is a leasing option. We look at the year. We can have here year 1 to 5. So year 1 to 5. Year 1 to 5. We are going to lease that computer for 5 years. We have the cash flows. We can have them in thousands of shillings. So that we start. Then we have another year 5. In thousands of shillings. So we can have our annual after tax lease rentals the annual after tax lease rentals. The lease payments 150,000 per annum for 5 years. Tax rate was 30%. So we are having so 150 times 1 minus 0.3, the after tax. $150 times 0.7, that is 105. It's cash coming, we are spending, so it's a negative of 105. Then after using it for 5 years, we have the maintenance costs of 100,000 for 5 years. You can also include that. Annual after tax maintenance costs, it was 100,000 times 1 minus 0.3. That is negative 70. Then after the 5 years, we can sell it off at 100,000. The firm can choose to exercise the option to buy the computers for 100,000 after 5 years. So we have the purchase price. Purchase price, we don't adjust for tax. So after 5 years, we can buy it at 100, and again, it's a negative. So here we can have our net cash flows. Then you can put here our PVIF. The cost of capital that was available in that company was only the interest rate. In finance, you must discount. The interest rate is 16%, so we discount using 16%, everything there. So 16%. Now that would mean the 175, I believe we all appreciate that is an annuity. So the annuity 16%, 5 years. Excuse me. So we're having 3.2743. 3.2743. Then on the other side, we are having 1 over 1.16 raised to power negative raised to power 5. So 0.4761. 0.4761. And of course now, when you multiply together the present values, when you multiply together the present value, so that one is the so the present value. So this times this. And at the end of the day, the NPV so becomes the summation of that. So if we decide to lease, we shall incur the total cost of 620.6. 620.6. Then you look at the option to buy. So option two is buying. There are two key things that we need to take care of. We need to take care of the annual interest. The annual interest. And to get the annual interest, let's get our annual installment. Which equals to amount of loan. We borrowed 800,000 divided by PVFA, present value interest factor of annuity. The cost of capital was 16%, and the loan was to be repaid over a period of 5 years. Loan was to be repaid over a period of 5 years. Yeah. So this one becomes 800,000 divided by the 16%, 5 years is still here, 3.2743. 2743. So this one equals to so this gives us how much? So 800,000 divided by 2.2743. That is 244,327. That becomes our annual installment. So let's prepare the loan amortization schedule. We have the year. Beginning balance. We have the installment. Installment is paying partially the interest, and partially we pay the principal. And finally, we have end balance. So we put the figures in thousands of shillings. We have 5 years, year 1, year 2, year 3, year 4, and finally year 5. As we start our first year, our loan balance was 800. In that year, we are paying installment of 244. 244.32.33 to 44.337. Interest, the interest rate, we all appreciate the interest rate is at the rate of 16%. So this one equals to 16% of the beginning balance. Interest is paid on beginning balance. So you have our interest there. The loan that you're paying, the installment that you're paying is covering two items. It's partly paying the interest and partly paying the principal. So meaning that the principal becomes the installment minus the interest. And of course, the end balance becomes the amount of loan at the beginning minus the amount that we paid during the year. So tukianza mwaka tulikuwa na loan ya 80,000. In that year we repaid 116.375, and that is it. So you can track our principal. First of all, the loan amount that you're paying, installment is always fixed for each of the 5 years. The principal or formula will apply in all aspects. And of course, the end balance or formula will also apply in all aspects. Beginning balance minus the principal. And the balance at the beginning of year 1 and the balance at the end of year 1 starts our year 2. So this one equals the balance at the end of the year. And there we go. Yes. Then of course, we can get our interest tax shield. Now you can, we'll get it later because you're supposed to adjust for tax. Let's also do the depreciation because it's on reducing balance. Annual depreciation. The asset will be depreciated over a 5-year period. Depreciation, I have year 1, I have the year 1, year 2, year 3, year 4, and year 5. I can have the beginning balance, which will be reduced by depreciation. We're told at the rate of ngapi? Depreciation is on reducing balance basis. Corporate tax is 30%, so we need to less the depreciation. Then we have the end balance. Now, we'll have our DTS here, depreciation tax shield. So allow me to get, examiner has been silent on the depreciation rate. To get our depreciation rate, it's on reducing balance, so it cannot be the fixed amount all the time. So our depreciation rate, we use the concept of compounding, where we say that the salvage value was supposed to be how much? The cost is 800,000. the salvage value, the interest loan, the salvage value of the asset is 150,000. So to get the 150,000, which will be the value at the end of year 5 years, equals to 800,000 into 1 minus the depreciation rate raised to power 5. So you work out for R. So we take 150 divided by 800. 150 divided by 800, we get 0.187. So you need to get therefore 0.187 equals to 1 minus R. So if we do that, we subtract 1. So R, we get the fifth root. So having negative 0.8125 equals to negative R raised to power 5. So you can simply get the fifth root of that. So you have the fifth root of 0.8125. The fifth root of 0.8125. So the fifth root of 0.8125, our depreciation rate becomes 0.9593. 0.9593 roughly times 100, which gives us 96% roughly. So therefore, as you start, so depreciation here is at the rate of 96%, a very high rate. As we start our first year, our balance of the loan is 800. We less the depreciation, which equals to 96% of the beginning balance. And of course, end balance will be the beginning balance minus the depreciation. Beginning balance minus the depreciation. The balance at the end of year 1 starts our year 3. So this one equals to that one. Which we have it there. Let's have it. We messed up with the, sorry guys, we messed up with the calculations here to get the depreciation rate. I don't think it should be this figure here, but actually when we do 150,000, 150,000 divided by 800,000, we get 0.1875. So 0.1875 equals to 1 minus r raised to -5. So therefore, we get the fifth root of 0.1875. So the fifth root of 0.1875, so you're having 0.7155 equals to 1 minus r. So therefore, r equals to 1 minus 0.7155. So our depreciation rate becomes 0.285. 285. So if we make it a percentage, it becomes 28.5%. So depreciation rate is 28.5%. So here, the depreciation is at 28.5%. Sorry for that. So that our depreciation is 28.5% times that one. 28.5%. Yeah. So that at the end of the year, we are left with roughly the 150,000. Good. Then our DTS, which is the tax on depreciation, so equals to 30% times the depreciation. That is it, our depreciation tax shield. So therefore, the NPV of buying, we need to get the NPV of buying. We have the year, we can have year 0, year 1, up to year 5 there. We can put them in shillings. Then we can start with the initial outlay. Initial outlay we have to spend 800,000 to buy the machine. Cash is going out. We have after-tax maintenance costs. After-tax maintenance costs. We're given a figure there. The service and maintenance cost would be 80,000 per annum. So we're having 80,000 times 0.7, the after tax. So 80,000 times 0.7. That is 56,000. The cost. And it's for each of the 5 years. After the maintenance costs, I believe we had the interest, the after-tax interest. The after-tax interest, we take our interest. We had gotten our interest here. We adjust for tax. So like the first one, you're having 128 times 0.7 equals to 128 times 0.7. So the second year equals to 109 times 0.7. For the third year equals 87.7 times 0.7. Year 4 equals 62 times 0.7, the after tax. Then finally, year 5 equals to 33.6 times 0.7. That's the after tax interest. And for information, they should all be negative. They should all be negative. They should all be negative because it's a cost. Cash is going out. Then we add the DTS. So DTS for year 1, we have it somewhere. It's here. So equals to this. Year 2 equals to 48. Year 3 equals to that one. Year 4 equals to, and finally year 5 equals to that. Let's see if there is any other thing for that. So we bought, we've paid the loan, the interest is there. The salvage value, we need to print it there for year 5 service contract. We've already taken care of that. So the final thing, we talk about the scrap or the salvage value. the scrap value after the 5 years. We are told the scrap value was 150,000. Yes, 150,000. It's in year 5, so 150,000. So now we can get our net cash flows. That's the summation of all that. Then we can put here our PVIF. The cost of capital is 16%. 0 is 1. Year 1 is 0.8621. 8621. Year 2 0.7432. Year 3 6407. 6407. Year 4 5523. And finally year 5 0.4761. 0.4761. 0.4761. Good. We can get our present values. It's times this. And of course, we can get our total present value, our NPV. NPV. So NPV is the summation. H. Then we compare the two. So the NPV of buying around 832,000. The NPV of leasing was 620,000 negative. When we lease, it's a net cost of negative 620, and when we buy, a net cost of negative 836. And that's why in part you are being asked to advise the company on whether it should buy or lease the asset. So our advice would be the company should lease the asset since it is less costly. When we lease in thousands of shillings, it was a negative of 620. When we buy, It is a negative. When we buy, it's a negative of 800. The company should lease. That is it. That is what is expected of us as far as that question is concerned. That is what is expected of us as far as that question is concerned. So let's continue practicing as we prepare for our exams. Thank you so much. And I wish you all the best, even as you prepare for your exams. Continue practicing and thank you.